Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq, with daily insight on the Nasdaq-100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on the Nasdaq stock market. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining us this afternoon, we have Joyce, Managing Director on Nasdaq's Market Intelligence Desk. And Brian, not too much of a surprise to see big tech take a little bit of a breather considering the run-up that it's had over the past several weeks.
Hey, Jill, thanks for having me on. Absolutely, I would agree 100% with that. We've been talking about how much of a V-shaped rally this has been and seemingly very little pullback at all. We're still not even below last week's low. So even though we're down 2.5% to 3% today on the NDX, it's still a very modest decline in the grand scheme of things.
And let's take a look at your first couple of charts today so we can get some price action confirmation. First, looking at the daily, then taking a look at the weekly on the Nasdaq-100.
Yeah, so on the daily here, we highlighted last Thursday the bearish reversal on Monday of last week, which was formed the bearish engulfing candlestick pattern. It was a one-day downside follow-through, which wasn't even a full day, actually. We rebounded back up, but we then see again this week, just a couple of days ago, we had another bearish pattern right when price was returning to last Monday's high. It formed a dark cloud where in the morning time it gaps up higher on the open, came right up against last Monday's high, and then finished the day, at the bottom of the range, which covered about half of the prior day's candlestick. So for the second week in a row, we see two bearish candlestick patterns on the daily time period, which is nothing to be too alarmed about. But if we now transfer over to the weekly period chart, our second chart, I highlighted the last three candlesticks, which is this week and the prior 2 weeks. The last 2 weeks, we could see we had an up green candlestick 2 weeks ago, and then last week we gapped higher to start the week out, and then we finished at essentially the midpoint of last week's range. So that's another type of dark cloud bearish candlestick pattern. That on the weekly period, to me, definitely stands out more. We are so far seeing downside confirmation this week. We had a downgrade of Apple today by Goldman Sachs, which is adding to the weight or the heaviness, increasing the selling pressure that we're seeing. But also look at the momentum indicator, the weekly period RSI in the bottom lower panel, where the momentum topped out well below where we were back in January and February. So we have a higher high in price, but we have lower highs in that weekly momentum. So there's your bearish divergence. And kind of when you combine that with the daily period candlesticks and the weekly period candlestick, which we're showing some bearish reversal patterns, that's something definitely to be more cautious about.
All right, Brian, let's take a look at your next chart here, something new for Trade Talks, the audience, where we're looking at the NDX versus the NDXE. Tell us what this ratio is about and what you're identifying on the chart.
Sure. Well, as of yesterday, there were four stocks essentially in the Nasdaq-100 that were essentially contributing to 63% of this year's gains. If you expand that to 7 companies, the top 7 performing stocks were driving 75% of the gains in the index, and that's been reported on in many outlets. The few companies that are really driving the outperformance. What this ratio does is kind of confirms that. So with the NDXE is the equal weight version of the NDX, whereas the NDX is the market cap weighted version. So the NDXE is weighting each company on an equal basis. And when we make a ratio out of it and you put the equal weight in the numerator, when the line trades down, when the ratio is trading lower, that means the numerator, which is the equal weight, is underperforming. And so that's been kind of going on for the last 7 years at least. And it just made a new low earlier this month. So that just kind of affirms what a lot of people have been noticing, is that the gains in the NDX have been increasingly been taking place by fewer companies. And so that's just another confirmation of the breadth not being as good as maybe we would like to see. And so at some point that needs to resolve itself, where you want to see other companies, not just the big mega caps, do well. So when that ratio reverses to the upside, it doesn't necessarily mean the bigger mega caps have to come down in price. It could just simply mean that the laggards can catch up to the mega caps. And so we'll just have to wait and see how that plays out. But you can see the same thing also in the S&P equal weight over the S&P 500 as well.
All right, Brian, let's take a look at your last chart here of the US dollar. The DXY seems to be continuing its decline, and it makes me wonder if it's a reflection of the amount of uncertainty in a number of areas that we see at the US.
Yeah, I mean, the falling dollar typically is associated these days in recent years with a risk on activity, particularly with your larger blue chip industrial kind of companies. A lot of those companies fall into the value category, and definitely more so with overseas emerging market stocks as well. So when the dollar is falling, that's typically good for emerging markets, big multinational exporters here in the U.S. And that's what we've been seeing. But I just wonder if maybe the decline in the dollar, at least in the near term, has almost run its course. And I say that simply because looking at today's price action, we're down, as you can see, we've been down basically the whole month of July. In late May, early June, we had a dramatic decline as well in the dollar. But we're hitting that low first reached in 2020 back in March, around 94.65. And so usually when you hit a somewhat significant high or low for the first time, price action can hold that level and consolidate. So I think from here, I would expect the dollar is going to maybe hold this level and consolidate either sideways or reverse back up to the upside. If that were to happen, we'll just basically have to wait and see, how strong that bounce is. If we do get the bounce and it's strong to the upside, I suspect that would weigh on those Dow Jones Industrials companies, which have already been underperforming. The Dow is more than 10% below its 52-week high, 2020 high, and it's also running into a cluster of technical resistance here. If you connect the highs from February and later on this spring, it's coming in right about here. So Dow is at some technical resistance, and if we have a bounce here in the DXY, I think that it'll increase the pressure to the Dow as well as emerging market stocks. And that would be a concern because that's what I think we need in order for the market to have another leg higher to the upside. Again, we'll have to wait to see how the strength of this plays out. I don't want to get too cautious and too bearish yet, but it's just something that I would think we'd want to keep an eye on, particularly as we go into these late summer months, which on a seasonal basis tends to be weak performing months for the market.
All right, Brian, great stuff as always. Thanks so much for joining us on Trade Talks.
Okay, thank you.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.